the U.S. wants Venezuela to give back stolen oil, and that stolen oil is somehow the property of the United States. Is there any justification to that? Is there any truth to that? Where is this coming from? And why does the administration think it has ownership over this oil, especially since there is a U.S. company operating in tandem with the government legally there? Why does the U.S. think it has ownership over oil that's not part of that agreement?
Despite headlines about regime transition and political instability, 300 billion barrels of crude oil, an ocean of black gold that surpasses Saudi Arabia's reserves, outstrips Iran and Iraq, and extends 3 times beneath American territory, are at stake.
One of the things we have heard from the president and from Chevron this morning is that the U.S. oil assets and the oil assets in general in Venezuela were untouched. They're still functioning. Chevron says it's focused on its Venezuelan staff safety and the integrity of its assets.
This goes beyond one nation's resources. The U.S. just announced its plans to reshape global energy markets. Trump was clear about why Venezuelan President Maduro had to leave. The oil, commercial potential. American corporations might tap into deposits that make about 17% of the world's resources. This isn't the Middle Eastern light sweet crude refineries worldwide want, which is fascinating. Venezuela's terrain is unique, fits American industrial capabilities, and might change the world energy balance. Approximately 50,000 square kilometers of geological formation lie south of the Orinoco River in the central Orinoco Belt. Extra heavy crude oil is viscous, sticky, nearly tar-like, and difficult to extract and refine. Do not pump this substance out of the ground and ship it to a refinery. Extra heavy crude requires specialized infrastructure, refining methods, and enormous investment. Diesel, asphalt, and petrochemical industries use it mostly. The kicker that makes this position so strategically vital is that the U.S. doesn't have substantial local supplies of this heavy oil, but it does have refineries built to treat it. Pause and consider that. Venezuela supplies. America can process. It's almost too perfect, raising doubts about whether this resource and capability alignment was purposeful all along. The Gulf Coast refineries were designed for heavy, high-sulfur crude that produces diesel and other fuels. Venezuelan oil fits into American industrial infrastructure like a key. Why isn't Venezuela rich in oil if its reserves are so large and valuable? Why hasn't this brought success? The explanation is decades of deterioration, political decisions, and deliberate isolation. American oil corporations ran Venezuelan oil operations in the 1960s and 1970s. Production exceeded 3.5 million barrels per day, or 7% of global output. Venezuela was a global energy powerhouse and revenues flowed. Hugo Chavez followed. Industry was nationalized, seized American company assets. Without foreign knowledge, production began its long, agonizing decline. After the U.S. implemented harsh sanctions in 2019, Maduro's collapse intensified. Venezuela produces less than 1 million barrels per day, a fraction of its former output. A country with the world's greatest reserves producing less than 1% of global supply is an unfathomable resource management disaster. Where does reduced production go? Most of it goes to China, delivered under special exemptions to repay Caracas creditors. Maduro's dictatorship relied on Venezuela-China connections to keep oil and money coming despite Western sanctions. Interestingly, a large fraction goes to the U.S. Washington granted Chevron a special license in Venezuela, exempting it from sanctions that kept American crude flowing even as diplomatic ties deteriorated. This exception shows that the U.S. never entirely prohibited Venezuelan oil. Even during high tensions, the strategic value was excessive. Trump now believes American oil corporations will invest billions to reverse Venezuela's output fall and restore the fields to glory. Those expecting a speedy turnaround need to get real. Recent journalist photos of Venezuelan oil infrastructure show degradation, neglect, and systemic underinvestment. Facilities have declined, equipment failed, pipes leak, Storage tanks rust. Engineers, geologists, and technicians have left the country or the industry, causing a brain drain. The data from McKinsey consultants are startling. Venezuela needs $15 to $20 billion to restore 500,000 barrels per day of production capacity. Rebuilding an industry from near collapse, upgrading aged infrastructure, drilling new wells, establishing processing facilities, and training a staff. Oil doesn't just flow from a switch. This rehabilitation effort will cost hundreds of billions of dollars over decades. Historical comparisons help determine how long this may take. Iraqi oil was a prize of the 2003 U.S. invasion of Iraq. The Iran-Iraq War and the First Gulf War had already slowed production. But the 2003 invasion showed how hard it is to quickly restore oil production in a country with damaged infrastructure and an unstable government. Iraqi production tripled 20 years after the invasion. 20 years of investment, security concerns, political maneuvering, and a huge cost to regional stability that continues now. Venezuela confronts similar or worse problems. Infrastructure degrades more. The political scenario is unpredictable after Maduro's ouster. Who controls Caracas and how stable a new government will be are major concerns. Expertise is spread. Foreign corporations will want guarantees, legal protections, and assurances that their assets won't be nationalized again when political winds change. Oil markets don't always have patience for trust building. Everyone is wondering how Venezuela's regime upheaval will affect oil prices after markets digest this news. Before Christmas, the U.S. seized Venezuelan vessels, but oil prices scarcely changed. Over the past year, oil prices have declined more than 20%. As global economic development has slowed, demand has softened, and the market has been oversupplied. The risk of extra Venezuelan crude flooding markets years from now seems minor compared to current price drivers. Any peace accord between Russia and Ukraine might have a greater immediate influence on global oil prices than Venezuelan output rises that won't happen for decades. Russian oil flows, European energy security, sanctions enforcement, and the reconfiguration of global energy trade patterns after that battle overshadow Venezuela's pricing impact. But what counts beyond market fluctuations and heavy crude refining technicalities is this. This is a matter of sovereignty, consent, and whether American involvement in Venezuela would benefit Venezuelans or be a 21st century colonial asset grab disguised as development and partnership. Trump's verbiage about American corporations spending billions, rebuilding infrastructure, and getting Venezuela making money again sounds almost charitable until you realize companies don't invest billions for charity. They invest to get returns, which go to corporate owners, not Venezuelans. Pattern is familiar. Foreign firms often grab income from resource-rich nations while local populations benefit little. Infrastructure is created to export oil, not grow the country. Profits are returned. Damage to the ecosystem remains. Foreign. Firms' political influence harms domestic governance. Whether Venezuela can avoid this trap, whether any new arrangement truly serves Venezuelan interests, and whether the Venezuelan people consent to this new chapter in their oil history will take longer to resolve than the immediate scramble for investment opportunities suggests. The oil won't leave. It will stay in the ground until removed. Who profits from that extraction, and at what cost may be the most crucial question. Financial markets changed when Donald Trump declared Venezuela policy. Traders moved before most people understood the geopolitical ramifications. In pre-market trade, Chevron stock rose over 7%. American refinery firms' valuations rose 5 to 16% instantly. Phillips 66, Marathon Petroleum, Valero Energy, and PBF Energy all rose as investors anticipated a windfall from unparalleled Venezuelan oil access. This wasn't hypothetical. The smart money bet that the floodgates would open, and it wanted in before everyone else did. Casual observers missed what Wall Street witnessed. This goes beyond oil in the ground. The oil type, refineries that can process it, and geographic proximity make the combination almost too perfect to be coincidental. Trump wasn't being diplomatic when he said the U.S. needs full access to Venezuela's massive oil reserves after Maduro's imprisonment. His business opportunity announcement was evident to the market. He suggested American oil giants could invest billions to fix infrastructure, restart the oil industry, and get the country making money again. Let's be honest about who benefits most from this arrangement. Chevron has a particular edge in this situation. Even despite sanctions, they're the only major American oil company functioning in Venezuelan oil reserves under a special exemption from Washington. Chevron stayed, maintained its ties, preserved its institutional knowledge of Venezuelan geology and operations, and positioned itself properly for this time, while other firms were locked out. Chevron doesn't have to start over when constraints are lifted, investment flows, and output rises. There they are. They know fields. They know people. The obstacles are known. Stock prices rose 7% for a reason. Chevron was recognized for winning the corporate lottery. In refineries, the story becomes intriguing. Venezuelan crude isn't as sweet as most refineries like. This heavy, sour, sulfur-rich substance demands specialist processing equipment and methods. Venezuelan crude won't work in any refinery. However, American Gulf Coast refineries were built to handle this crude. These heavy oil plants were designed for sophisticated processing of thick, sulfur-laden petroleum into diesel and heavier fuels. These refineries' layout, technical capabilities, and processing units match Venezuela's production almost exactly. A natural fit, say energy specialists. Venezuelan crude quality matches Gulf Coast refineries' historical design criteria, according to Pepperstone research analyst Ahmad Asiri. These facilities have processed heavy crudes from other sources for decades, but Venezuelan oil is closer. Shipping heavy crude from the Middle East or elsewhere is expensive, time-consuming, and complicated. Venezuela is basically America's backyard. Shipping distances are short. Transportation infrastructure exists. Simple supply chain. For refineries that process heavy oil, a big new source just a tanker ride away might boost margins and efficiency. This explains refinery stocks' even greater rise than Chevron's. The companies don't expect future prospects. They want more of the crude their facilities need from closer suppliers for quick, real benefits. The market prices more utilization, better margins, and lower transportation costs. However, the reality check is significant. Energy analysts warn against timeframes and expectations while traders and investors celebrate potential rewards. Former Chevron executive Ali Moshiri managed the company's Africa and Latin America exploration and production divisions. His ambitious strategy shows the breadth of possibilities and the enormity of problems ahead. His investment fund, Amos Global Energy Management, is raising $2 billion for Venezuelan oil projects. Moshiri told the Financial Times that his fund is in talks with institutional investors about a private placement to start investing in Venezuela. Response has been astounding. In the 24 hours after Trump's statement, Moshiri received 12 calls from eager investors. He was amazed that investor interest in Venezuela rose from 0 to 99% overnight, not gradually warming to an opportunity. That's stampede. Institutional investors who wouldn't touch Venezuelan projects last week are now clamoring to invest in funds targeting them. When the U.S. government announced its plans, risk vanished. While significant, $2 billion is a fraction of what Venezuela needs. Remember McKinsey's estimate of $15 or $20 billion for every 500,000 barrels per day of production capacity. Moshiri's fund likely covers one production restoration increment if fully subscribed. Venezuela needs millions of barrels per day to resume production. The math predicts decades of investment of hundreds of billions. $2 billion is a start, maybe a proof of concept, but not enough for Trump's total repair. This is where analyst warnings matter. Numerous energy experts warned that Venezuelan oil output will take time to recover, regardless of cash availability. Political uncertainty persists. Maduro is gone, but who runs Venezuela? Kind of governance emerges? Will it be stable? Will it uphold transition period contracts? Venezuela has burned foreign oil corporations, nationalized assets, seized investments, broken contracts. Without strong legal protections, political guarantees, and promises that history won't recur, companies won't return. The infrastructure reality follows. Maintenance has been delayed by decades of underinvestment. They've systematically damaged oil-producing facilities. Wells must be repaired or re-drilled. Replace pipelines. Processing facilities must be rebuilt. Storage terminals require fix. Ports need renovations. The operational power grid needs stabilizing. Skilled workers need foreign training or hiring. Establish supply chains. All aspects of Venezuelan oil extraction involve attention, effort, and time. Chevron has done large-scale rehabilitation. They've handled severe political situations, complex reconstruction projects, and hostile environments. Restoring oil infrastructure takes years, not months, for competent operators. Capital doesn't immediately restore well flow. Assessment, planning, engineering, equipment procurement, construction, and progressive ramp-up are needed for each sector. Multiply that by hundreds of fields over 50,000 square kilometers, and the schedule lengthens. The Iraqi example is relevant. 20 years after the 2003 American-led invasion, Iraqi oil production tripled. Massive investment, worldwide assistance, advanced technology, and consistent work for 20 years. Iraq still struggles. Venezuela's start may be worse. The infrastructure is worse. Its politics may be more brittle, more human capital depleted. How long will Venezuela need to restore two-thirds of capacity if Iraq needed 20 years to triple production? The market seems willing to overlook these grim timetables and bet on success. Stock prices indicate confidence that American corporations will obtain access, investment, output, and profitability. Capital is poised to flow, but that optimism may be unfounded. Institutional investors await. Private equity funds form. Old Venezuelan exploration maps and development plans are being revived by oil companies. Capital deployment is underway. It's remarkable how rapidly sentiment changed. Venezuela was a pariah last week. Prohibiting investment and business. Global energy markets' biggest opportunity this week. That kind of whiplash shows how much politics, not economics, drives resource extraction investment decisions. That oil was always there. Reserves are unchanged. Infrastructure issues predate and persist. What changed was American political will and the signal that Washington would encourage business involvement. This is a generational opportunity for Chevron and American refineries to secure decades of resource supply. Moshiri's fund and related vehicles offer early access to one of the coming 20 years' biggest oil development tales. Venezuela faces an uncertain future. Does foreign investment lead to economic growth and better living standards for Venezuelans? Will this be another chapter in the lengthy history of resource extraction that rewards foreign businesses and local elites while ignoring the public? The stock market decided. The actual world will judge much slower.